What do you see now?
An assume list.
Okay.
Were you gonna like click around?
Yeah. So what I was gonna do was I was gonna just show the map and then show kind of a couple of the features. Like this got this draw feature where I could just draw around Denver, and it'll filter out all the properties that are within that on this right side that have that are available. So let's just say this one here, right? So if I click that property on there, it brings up the rate, how long is the mortgage, what kind of loan it is, what's their balance, right? What's the estimated payment? See that?
Yep.
And so basically if they're selling, this is active, right? So if you look at this, this is active. So it's on the MLS 1 day. So they're selling it for $9,999. But if their balance is $619, then you got to come up with that difference.
Yep.
Right? So somebody doesn't have that money, they can't do it, other than the fact that I have a lender now. Actually, I have a couple of lenders that will finance up to 90% CLTV.
CLTV?
Yeah. Combined loan to value. So basically, you take the $9,999 times 90% minus the balance, and then that difference is what they'll lend. So they won't lend all 381. They'll lend, right? So they'll lend up to 90% of this minus the existing balance. That's the difference. That make sense?
But that part's 10%?
Yeah, so the buyer has to come in with at least 10%. Right?
Yep.
So let's just say it's an even million. Right? You with me?
I think so, yeah.
All right, so the price is $1 million, and then there's a gap between the 619 and the million. The lender will lend million minus 10%, which is 900,000, right? So you got to come in with the first 100,000, and then they'll lend on the difference from the 900,000 down to the 619. So let's just say it was 600, right? So let's just say the balance was 600, just for even numbers. So they'll lend 300,000 on top of the 600,000, but you got to come up with the first 10%.
Wait, maybe I'm not following.
Okay.
The point of an assumable loan,
yeah,
is to get that 3%, say.
Yeah.
Well, I guess. Oh, you're talking down. So if it was an FHA loan, 3.5% down.
No, it doesn't work that way. The balance doesn't go up again and start from the higher amount. You only get to take over the existing balance.
Right.
Okay.
But you've got to pay off the.
No, you don't got to pay anything. But you're not paying off anything. You're coming up with the difference. So the servicer will, let's say, hey, we'll let you take over the 619, 179 at 3.2%, but the price is $1 million. Where's the difference coming from?
Right.
Either your pocket or a lender can bring in that gap.
Yep.
Right. So the lender that does the gap is a home equity lender, right? But they won't give you 100% of that gap.
Right. You got to put down 10% of the gap.
No, 10% of the price.
The full price.
CLTV is combined loan to value.
So it's higher. It's a lot higher than.
Well,
10%.
It's 10% of the purchase price.
Yeah.
You got to come up with 10% of the purchase price.
Yeah. So that's That's no joke. So
Right. When you're having these big ones, but it's better than coming up with 381. Right. And if you're buying in the $1 million range, I mean, if you don't have 100K, what business you got trying to buy there anyways?
yeah, good point. I mean, you're gonna have to put down.
You're gonna do, yeah.
Yeah.
And then this is out of the FHA range anyway, so you couldn't get 3.5%. Let's say you were gonna get your own FHA loan.
Right.
This is over the FHA limit.
Right.
You could buy. So I mean, so this is a prime example, right, of one that's kind of unique.
Yep.
Right. But let's take a one that's a lower balance. So let's take this one, for example. Okay. So I like the $1 million because it's easy round numbers.
Yep.
So this is another VA, right? So the down payment difference is $35,000.
Yep.
Right. So technically, you'd be coming in with 10% anyways. So you should have the difference.
Mm-hmm.
Right? Because if you came in with 10%, you'd have to need 38. Well, if you have 38, then you have more than enough to cover the difference, right? And you just take over the 345 balance.
Mm-hmm.
Right?
Yep. Okay. Yep.
Let's look for an FHA one. Another VA. Jeez, these VA loans are cheap. My goodness.
What's it?
This one's 2.64.
Yep.
It's insane. Insane. All right. Let's see. All right. So this one's 550. Let's see. This is FHA. So also the challenge with VA is if you're not a veteran and so let's say you assume this loan, but you're not a veteran, the entitlement of the veteran currently owning this remains.
Yeah, they don't get it back.
They don't get it back until that loan is paid off. So that's a challenge in trying to get somebody to sell you their house and leave their VA entitlement if you're not a veteran, right?
Exactly.
You don't have that challenge for FHA loans. But let's just say a veteran did that and that's okay. Right? If you're able to get the veteran, but you're not going after the 1 days on the market for that, right? You're going for the ones that are over 30 days, 60 days, 120 days to say, hey, your house isn't moving. You're not selling it, right? How about you sell it to me with the assumption, or if you're the agent, that should be your pitch to your seller. Say, hey, this isn't moving here at either the price or the affordability is the issue. Are you open to selling it on an assumption? If they have an FHA assumption, when they assume it, then you're released. But if you have a VA one, it may or may not get released depending on who the buyer is.
If it's a VA buyer, it's released. If it's a non-VA buyer or non-VA investor, then it's not.
Correct.
Released. Yeah. Yeah.
Correct.
So we'll definitely talk about that.
Right. Yeah. So that's the good and the bad.
Yeah.
Right. Let's see. So, let me see. Okay. So this thing has, right. So I can unclick VA and I can click on USDA and it'll give me just the FHA ones. Right. So this was a nice and even number. Okay. So this is FHA. So you don't have that issue. Right?
Yep.
So if you qualify, you get to take over this 2.73% rate. Okay.
Mm-hmm.
So you either have to come up with the difference or come up with 10%, which would be 40, and the lender will lend the other 65. Does that make sense?
Yep.
Okay. So let's run through this scenario, right? So I have a little worksheet, an Excel worksheet. It's called a blended rate.
Okay.
So if you combined, right, because the second, the lender that will lend on the second isn't going to give you 2.73%. They're not even going to give you 6%. The rates are going to be maybe in the 9s or 10s. Right?
Mm-hmm.
But if you borrow 60,000 at 10%, but you're borrowing 295 at 2.73, is that better than getting a whole new loan at 6.5?
Are we live?
No, we're not live.
Oh, it just says live. I was like, oh shit.
Oh, we are live. I guess I must have clicked something.
Can we start over? We got to do our intros and stuff.